Hey traders, this is Blake Morrow with Traders Summit, and today we have Jim Welsh from Macro Tides. Good to see you. Must be Friday. How you doing, Jim?
It's Friday, and it feels like a long week because it was a 5-day work week after having a holiday last week. So
Yeah.
I think I'm ready for the weekend, Blake.
I bet you are too, and I bet you're not the only one. Here we are. And the reason why I say that is here we are at the lows of the session following the jobs report. It's Friday. We got to talk obviously about the price action here. We had a really bearish reversal candle on a monthly S&P chart. Here we got, the jobs report came out. It came out, it's underwhelming, but there's some things under the surface you probably want to talk about, right, Jim?
Absolutely. People have to understand that there are two surveys, Blake, when they come out with these numbers. One survey is for businesses, and that's where they derive how many jobs were created. And second survey is household surveys, and that's where they come up with the unemployment rate. And there's a huge dichotomy this month where, 210,000 in the official survey of businesses, but the household survey had about 600,000. And that's why the unemployment rate dropped as much as it did to, I think it was 4.2. The other thing that I look at is the U6, which is the number of people that may be working part-time but want a full-time job. And I believe that was at 7.8. So one of the things I came up with about 6-7 years ago was looking at the spread between the U3 and U6 rate. And I discussed this in detail in the December Macro Tides. And I'm going to offer that if somebody wants to send me an email, Jim Welsh Macro@gmail, I'll send them the December letter because it goes into it in detail. But basically, when the spread narrows between the U3 and U6 rate below 3.85%, wage pressures are strong. And that's been the pattern over the last 20 years. Well, with this newest data, it's at 3.6%. So that to me really is a better indicator of labor market tightness than the Fed looking at participation rates, which are a lagging indicator. So to me, this underscores that the labor market is still strong, and I think we're going to run out of workers, and that's going to maintain upward pressure on wages.
So let's talk then about price action. Here we got a weaker data by, people look at the headline.
The headline.
Yes, but as you're pointing out, it was actually a pretty strong jobs report. The market is responding negatively, and the reason why that is because people feel that the Fed this month will probably increase the taper. And do you think that's the conclusion? Because we're seeing the dollar strengthen, the euro's back below 113. You got the Aussie dollar nearing 70 cents. Stocks are under pressure. Is that the reason why we're selling off?
That's my take. As you know, we talked about this for weeks, that I thought that the Fed would be wise when they had the November 3rd meeting to announce 20 billion, because they've lost a lot of credibility with the inflation is going to be transitory. And then obviously it wasn't. Yeah. And so in my opinion, the Fed there's a good chance they're going to go to 30 billion when they make that announcement on December 15th. Because by going to 30 billion, the taper will be completed by the end of March. And I think at this point in time, the Fed just wants to be done with it. And labor market tightness is becoming more and more evident. So I think that they want the decks clear so they can evaluate when they're going to move on rates. And I think 30 billion. And that I think the market would probably not like that number.
So if the Fed's not seeing this as something that would deter them, how about the Omicron variant for COVID?
Yes.
Do you think that's going to have an effect on the Fed too? Because I was in the camp that if we had a weak jobs report, and by the way I agree with you that it may surface looked weak but not below the surface. But if it was really a weak jobs report and the Delta variant, maybe it might have swayed the market a little bit. But do you think this COVID variant is going to have any effect on the Fed?
Unless it really shows that hospitalizations, the severity of illness is going to be more than currently expected. Right now, all the cases that have shown up, not just here in the US, because we're talking about a handful, but around the world, have been very, very mild. So I think because of natural immunity, vaccination in the US, it's likely to be very mild. And so unless we see it being far more severe, I don't think that would dissuade the Fed.
Okay, well, that's good to know. So now you know, here we got the S&P. It's trading below the 4550 level. That was a big breakout point for the market. A lot of people were looking at that as a big, you know, neckline
Support. Yep.
Yeah, huge support. We're trading slightly below it today, but you have a view of the S&P, and I thought I'd show your view. And can you talk a little bit about how you feel about the S&P right now? Because, you know, I think you probably got a lot of bulls that are like, oh, wow, I'm wrong-footed, but here we go into the December, you know, month, which is typically a stronger month for stocks, for the Santa Claus rally. So what are you thinking here?
Well, first of all, let me just very quickly say, if you look at a chart of the VIX, and I'm sorry I didn't provide you one, but
okay, this is the S&P for everybody.
S&P 500.
Yeah,
that's right.
Okay, but go ahead and talk about the VIX.
Yeah, real quick, because that provides us some context. So what I wrote about in this last week's Monday weekly technical review was, if you look over the last year, there have been a number of declines where the VIX would hit a high, the S&P would bounce, and then the S&P would sell off and either test or modestly make lower lows, and the VIX would hit a lower high. So my point was, I think we're going to have a correction, and we're going to see a bounce, and then we're going to have another sell-off that'll take the market below the 45.85, which obviously happened in spades. But the VIX made a higher high over the last few days. So to me, this just says, all right, there is a bounce coming, but I think after a bounce, we're going to see another leg down in the S&P. This pattern that we're showing on the screen here looks from the high at 47.44. To me, you can count 3 waves down for a small wave A, a bounce for B, another 3 waves down for C. So I think there's the potential, Blake, that we will hold at this point in time above 4,500, and then see another rally that takes us above yesterday's high, or this morning's high, I think it was 46.05, something like that.
Yeah.
And that's a bigger ABC up for a capital B. And then I think there's a C wave down that potentially could take the S&P at a minimum below whatever low we hit in the next handful of days, potentially down below 44.50 towards 4,400. We just have to wait to see how big the bounce is. A 618 retracement of the decline from 47.44 to 45.05 is about 46.50. So I think there's the potential that we hold, get another pop up to 46.50, and then I think there's another pullback coming before we'll have a more significant low, trading low, that will mount a rally that I continue to believe the S&P in January is going to go to a new all-time high.
Okay, so just to sum it up for everybody at home, you know, maybe from here we get a bounce to 46.50, then back down below 4,500, maybe a brand fresh low, then brand new highs going into January. So we got a little move higher, move lower, and then, you know, move to maybe all-time highs going into the beginning of next year.
In the first quarter. Absolutely.
Okay, well, Jim, I'm going to tell you, you know, that is a pretty good playbook. I think a lot of people are probably going to take that and they might run with that thesis. I like what you do here, and I like the fact that, you know, your subscribers to your newsletter, you update them, especially if something really big changes. You send out an email blast to all of them. I'm one of them. How long have you been writing your newsletter?
Decades. See, I got the hair, lack of and gray to prove it, but for a real long time. And again, as we've talked, I combine technical analysis and fundamental analysis. Not too many people do that. I think you have to have the whole picture, and that means combining fundamental and technical analysis.
Yeah, I remember you back in the 90s. I think you had red hair. No, I'm joking. Hey, Jim, I want to say thank you so much for your time. We really appreciate your knowledge of the markets, your macro backdrop of what's happening. And I want to say have a great weekend, and thank you. And we'll see you next Friday.
All right. Have a good one. Thanks, Blake.
Thanks, Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.